Valuation concerns around high-flying AI stocks have weighed on markets in recent sessions. Are we actually in a bubble when it comes to those AI plays? And what steps can investors take to protect themselves? Joining us now to discuss, Brad Simpson, Chief Wealth Strategist with TD Wealth. Brad, great to have you back in studio.
It's great to be here.
All right, so we get all this kind of turmoil, and we've had some choppy sessions. AI seems to be at the center of it, and the tech stocks, people start talking about 1999, 2000. Compare and contrast, I guess is what I'm asking you.
Yeah, I guess sometimes to be good, you have to be a little bit lucky. And we published our quarterly strategy, I guess about 10 days ago, and the title of it is "Artificial Intelligence: The Last Temptation." And it's really about looking at markets and look at the valuations and here we are kind of in what we'd call kind of a mini correction this week at any rate. And I think that is the big question, that should I be in or should I be out? And is this 2000 and over again? And you look at that. And I get it. There are definitely similarities between the two. I think if you look at it, the narrative back in the 90s was the internet's going to change everything. Now the narrative is AI is going to be everything. Then, if you looked at back then, there was massive retail participation. Oh, we brought a chart. Look at that.
Yeah, let's walk through this chart
with our crack team here. And on the other side of that is that today there's massive participation from retail, but there's also this passive ETF that you can double lever or triple lever to be able to go out and do it. And so that I'd say that's a pretty interesting. High valuations, negative equity risk premium, elevated multiples, an exuberance in the market. The weak breadth, lots of tech dominance back then. Today, same sort of thing. Easy monetary policy, lots of talk of productivity miracles. Today we've got easy monetary policy, and we also have politicians really involved. We have a lot of fiscal policy and is kicking it down the can down the road, and lots of debt being accumulated, and all this is creating a lot of more money in the system. So if I were a person investing in technology today and then look back at 2000, I think I'd look at some of the similar things and go, ooh, wait a minute, right? Now, there are also some really significant differences.
Okay.
Right?
Let's get into those, yeah.
Right, and I think that's the piece that we really want to be able to hit home here on, is that right out of the gate is that, if you look back at the late 1990s and the dot-com craze, is that you had these theoretical businesses that were going to do incredibly well, trading at 100 times if they had earnings. Most of the time they didn't. Today we have very real businesses doing very real things that are very profitable. Trading at somewhere between if you want to use a band of 30 times earnings and 45, which is hardly giving them away, but they do have very real earnings and very real business, and I think we have to be incredibly mindful of that. And so I think on balance, when we look at this, is that the summary of our quarterly strategy is that this is not an in or out decision. Right? So if you are all in on the AI trade, I don't think that's where you need to be, and I think that's probably going to end badly. I think if you are all out and you're saying, I'm not going to have exposure to artificial intelligence in my portfolio, I think that you're really going to miss something significant. And I think the starting point of that is that if we go back and we look at the late 1990s, the things that we did, the things that the internet promised, it delivered on. When you're watching Netflix, when you're on Facebook, when you're buying something from Amazon, that was all built on that digital platform and delivered what we thought it was going to. It's just we had a bubble along the way. This time, we have a similar scenario, except the companies who are doing it are really profitable. Now, the chart I brought along here is to kind of hit this home is that, I was a massive critic of the late 1990s, and I'd argue many of the ways it's what's led to my success in my career that was the first third of my career, if you will, and this is going to end badly, and you need to make sure you don't get caught up in this. This time I'm saying this is a different scenario, and we have to manage through it a different way. But if I'm wrong on either one of those, if I was wrong then or if I'm wrong now, the bottom line is you have to build a diversified investment portfolio. And what we're looking at here is if you look at 1999, that's really when the dot-com went parabolic. So NASDAQ up 86%, S&P 500 up 20, a balanced portfolio was up 17%. 2000 is the first when the first crack happened. NASDAQ goes down 39%, the S&P goes down 10, balanced portfolio goes down 2. Next year, NASDAQ goes down another 21%. TSX or the S&P 500 goes down 13, balanced portfolio goes up 6. We get a 2002 again, right? 32 down for the Nasdaq, 23 for the S&P, down about 8 for the balanced portfolio. Nice rally in 2003. You close out the year. If you look at that as like a 4 to 5 year time horizon, and you were diversified through that parabolic movement up to the big crash down, at the end of the day, for the balanced portfolio, you were up 20%.
If those are still negative, yeah.
Right, and if the S&P 500, you're down 10, the NASDAQ, you're down 9. The message here is sometimes it gets boring to listen to asset allocation guys like me, but the bottom line is that in environments like this, the absolute best thing you can do if you want to grow and protect capital is do that. Do not be all in, do not be all out, run a good diversified portfolio. And if we're wrong on the call either way, ultimately it's irrelevant.
And longer term, when we think about AI, and some things might get shaken out, and we're going to get through that. But it struck me the fact that the parallels you're talking about, the internet, so much promise. We did get the bubble and the pullback, but it did change the way that we work, the way we conduct our lives. Longer term AI, do you feel it has that potential? It will become ingrained in society.
Yeah, this is a bigger deal than the internet, and if you actually look at the promise of the internet and what it's delivered on, it's delivered well beyond what the promise was. Artificial intelligence is going to be exactly the same thing, and I think you can go as far as to say is that we are in perhaps the most significant. We are in the revolution since the steam engine in the 1800s, and that transformed the way we lived our lives. And so I think it's unbelievably significant. And for clarity around there, these industrial revolutions you go through are never smooth. Right, like there's going to be severe ups and downs with this. We're going to have to build and manage our way through it. But absolutely, this is a change that is going to impact our society, how our markets work, how we think about things, and we're going to have to think very differently as we go through this.